Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering some of the basics of incentive stock options and how and when to recognize income. We'll be covering stock options in greater detail in our upcoming Stock Incentive Plans webinar on February 2nd. You can see a list of topics covered and get registered for this live 2-hour course at spidell.com under webinars. An incentive stock option, or ISO, is a corporate benefit that gives an employee the right to buy shares of company stock at a discounted price with the added benefit of possible tax breaks on the profit. ISOs are also called statutory or qualified stock options. An employee does not recognize income when an ISO is granted. Instead, the income is recognized when the stock is disposed of. An employee will generally recognize income in the year in which they dispose of the stock purchased under an incentive stock option plan. A disposition occurs when legal title to the shares is transferred, whether by sale, exchange, or gift, or if the employee delivers the stock in payment of the exercise price of any other ISO held by the employee. Typically, a gift does not give rise to a taxable event, and the recipient takes the gift subject to a transferred basis and will recognize all the gain on the stock when it's sold. The grant date is the date the employee is first granted the option to purchase, at some point in the future, shares of their employer's stock at a stated exercise price. But the employee has to typically wait a period of time, which is defined in the ISO plan documents, before they can exercise their option to purchase the stock. The waiting period is also referred to as the vesting period for the ISO. An employee also does not recognize income for regular tax purposes when an ISO is exercised, but ISOs are subject to an AMT adjustment when they're exercised. How the income is taxed depends on whether the disposition is a qualifying or non-qualifying disposition. A qualifying disposition occurs if the sale or other disposition of the stock takes place more than 2 years after the date the ISO was granted for the particular shares involved in the disposition, and more than 1 year after the date the option was exercised for those shares. If both of these requirements are met, then the disposition is a qualifying disposition. Otherwise, the disposition is a non-qualifying disposition and is taxed differently. In a qualifying disposition, the employee recognizes long-term capital gain or loss by subtracting the exercise price paid for the stock from the sales proceeds. Generally, a non-qualifying disposition of stock purchased under an ISO plan will result in ordinary income, calculated by subtracting the exercise price paid for the stock from the fair market value of the stock on the exercise date. But an arm's length sale or exchange with an unrelated party can result in capital gain income as well, and a disposition at a loss will generate a capital loss. Employers are required to issue Form 3921 by January 31st of the calendar year following the calendar year in which an employee exercises an ISO. Form 3921 provides the information that's used to calculate the employee's AMT adjustment on the exercise date, as well as taxable gain when the stock is ultimately disposed of by the employee. An employee will receive a different Form 3921 for each stock option exercise during the year. You'll get all the news you need to keep your clients current, as well as new tax planning strategies to minimize taxes throughout the year with a subscription to Spidell's quarterly federal tax update webinar series. The next update is on February 8th, and you can buy 4 sessions at a discount at spidell.com under webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.